Hi, my name is Chris Vatic. Today we're talking about accounting. You may think accounting is boring and too technical. You may think there are just way too many rules out there that are impossible to learn while we have a busy agenda each day. The good news is that there are just 5 fundamental accounting principles that stand out, because if you make the effort to truly understand them, you can reason into almost any accounting challenge that comes your way. So let's jump in. The first principle is the purpose of the 3 financial statements. First, there's the P&L. It's also called profit and loss statement or income statement. And it's used to record revenues and expenses and derives from that what a profit is. P&Ls are prepared to reflect business activity in a given period, for example, in a month, quarter, or year. And companies record the value of their assets, liability, and equity on a balance sheet. While the P&L shows the current business performance over a period of time, the balance sheet provides a snapshot of how the company is structured. It reveals how it's being financed, with important metrics such as equity to debt ratio, and it also shows how efficiently the company is run, for example, by comparing inventory levels to sales. The cash flow statement is perhaps the most straightforward. It simply measures cash flowing in and out of the company. Other than the P&L, it excludes accounting entries that are necessary to match expenses with revenues, but don't result in money changing hands. That allows us to determine how much cash we have left to reinvest in the business or pay out to shareholders. And the second principle you need to understand are the components of the 3 financial statements. Fortunately, you don't need to understand each and every line item on your P&L and balance sheet or cash flow equally. Some matter more than others, and that varies from industry to industry. So, for example, a consultancy business focuses mostly on people-related expenses, while a manufacturing business may put more emphasis on production costs and capital management. The most important point I would like to make here is that you need to be intimately familiar with the P&L, balance sheet, and cash flow items that matter for your company. So what do I mean by being familiar? Essentially, you need to know 3 things for each of those line items that truly matter to your company. First, you need to understand what the strategy is for these metrics, right? Do I want to maximize them, minimize them, or optimize them some way? How do I want to go about doing that and why? And the second thing you need to know is how to track them and measure them on an ongoing basis. And finally, you need to be intimately familiar with what good and bad performance mean for each major line item. And the third essential accounting principle you need to know is debits and credits. Every financial transaction is recorded with a debit and a credit. That's called double entry bookkeeping. And it's a standard that has been around for, more than 500 years. It makes sure that all of our financial records are done in 2 places, which allows us to have better financial controls to make sure that nothing gets missed and everything is recorded correctly. And we do that by making sure everything ties out. What do I mean by that? If you have all your debits and credits together on one sheet, we call it a trial balance, then you can make sure they match. You should have an exactly equal amount of debits and credits in your trial balance. If you don't, then it means there has been an error in your bookkeeping that you need to correct. And the fourth principle you need to understand in terms of accounting are accruals. There's cash accounting and there's accrual accounting. The vast majority of companies uses accruals to record their financial transactions. In simple terms, an accrual is a way to write down when money has been earned or spent but not yet paid. okay? So let's say you buy a company car. And as soon as you start driving that car, you report that value as an accrual. But you may only be paying the car off at a later point in time. And we talk about the reason why companies have accruals next as part of the fifth essential accounting principle. I consider the matching principle the golden rule of accounting because it can be used to predict the likely accounting treatment for even the rarest and most complex transactions. Even if you don't know the specific rule, it's great to make quick assumptions about what the likely accounting treatment will be like while waiting for confirmation from your accountant, for example. In essence, the matching principle says that benefits the company receives, for example in the form of revenues, must be matched with associated expenses in the same period. So for example, it explains why investment in machines need to be amortized over the useful life of the asset. Let's say you're buying a machine or a tool to use in your business, right? You may have to pay everything up front, but you won't reflect the entirety of that payment in your P&L up front. You create accruals that are spread out over a long period of time. That's the amount of time you're planning to use the machine for. It could be as long as 10 or even 20 years. And the reason we do that is because we are getting the value of the machine, that is the ability to make our product, over that long period of time. So it's important that we record the expenses over the same period of time. That's the matching principle. And that's another excellent example of why so many companies choose to use the accrual method instead of the cash method. The reason is simply that it allows us to show a profit that is more in tune with the business realities. And there you have it. Those are the 5 most essential accounting rules you need to know. Of course, this was just a brief introduction, and I would encourage you to research them according to how they matter to your company.